Well, good day, everyone, and welcome to this afternoon's FS Club webinar here at 3 p.m. in London. I have with me my dear friend, Khurshid Ahmad, would normally be dialing in from Trinity College, Dublin, but due to the pandemic, he's actually located in the UK, so it's not quite as international as I was hoping for. But Khurshid is going to be talking today about a great topic. Did the market move for you? Artificial intelligence and financial and commodity trading. And Khurshid's been doing a tremendous amount of research over the years. Now, you'll all know me. I'm Michael Mainelli. I'm one of the directors of Zien. And it really is my privilege to be able to introduce so many of these webinars. And I can only do so thanks to the generosity and, frankly, the tolerance of our sponsors who allow us to range widely and freely across technology, economics, and finance. And today, Khurshid is going to be showing us quite a bit about all three areas. Obviously, the technology that he brings to bear as a professor of computer science at Trinity, obviously the financial elements of markets, but also the economics of sentiment and behavioral analysis. So it's quite a rich presentation. And because of that, it's my job to get out of the way as quickly as possible. But before I do so and hand over to Khurshid for kind of a very impressive 20-minute presentation, I would just point out a few things, if I may. Firstly, the slides are already going to be available online. We will be posting a copy of the recording. But most importantly, we've reserved 20 minutes for question and answers. There's a lot of interesting subjects here that Khurshid is going to touch on. So if you would like to get your questions in, please use the GoToWebinar question facility. All of your questions will be sent to Khurshid with your email. So if there's points of detail you'd like to pick up but don't want them broadcast across here, that's fine. But I'll be feeding in the questions that I see into a conversation with Khurshid for about 20 minutes. So with no more ado, if I may, I would like to hand over to Khurshid. We're just behind the scenes giving him control of the slides, and I would like to say over to you, Khurshid. The floor is yours.
Thank you. Thank you, Michael. It's very kind of you to invite me. It's always dangerous to invite academics because they change topic halfway through and don't stick to time. So I'll try not to do any of this thing. So the title is, Did the Market Move for You? AI and Financial and Commodity Trading. I put the word AI into it because it now comes with every food, beverage, drink machine. So I thought you might be attracted more towards AI. Okay, so what I'm going to talk to you much today would be about noise. It's not a long way, but you'll hear noise from me. You hear about noise from me in more than one way. And the person who pointed out in modern times was Fisher Black, very famous gentleman who founded a big organization to do option trading. And he was a mentor of a large number of econometricians and financial academics. So these are the take-home keywords. Behavioral finance is simulated intelligence, emotional intelligence, plus time series analysis, which actually is about making noise, modeling noise. Effects of noise on the world, Richard Black says, and on our views of the world are profound. Noise is rooted in a small number of small events and is often a causal factor much more powerful than a small number of large events could be. Noise causes us to be somewhat inefficient, but often prevents us from taking advantage of the inefficiency. Now, in finance and in finance generally, the term efficiency means that the prices are not correctly given, so you can take advantage of people not realizing the prices will go up or will go down. So that's what efficiency means. Fisher Black had a great lot to do. And the other favorite person I have is Richard Thaler, who got a Nobel Prize in 2017. And he talks about this very interesting topic about fungibility. What is fungibility? Let's see. And he says mental accounting violates the economic notion of fungibility. Money in one mental account is not a perfect substitute for money in another account. Because of violations of fungibility, mental accounting matters. Now, I'm talking to a group of people. Some of you know a lot about finance. Of course, many of you, all of us know accountants, and they're very precise people. You know, credit and debit columns have to be exactly balanced out, and the sum total should be generally correct. Okay. Now in mental accounting, we don't do that. We don't price the same thing. Your saving in one account is not the same as your spend on your luxuries. The same amount of money is treated differently, and this is often a great problem in trade. People don't price things correctly because they're using mental accounting instead of what we call physical accounting. So here is a poll for you, a quiz. Britain is becoming a nation of quiz people. And in this quiz, I have three things: fungibility, nudging, and framing. I'll come to that. Suppose you bought a case of good 1982 Bordeaux in futures market for $20 a bottle. The wine now sells at auction for about $75 a bottle. You decided to drink a bottle of this wine over dinner. Which of the following best captures your feeling of the cost to you of drinking this bottle? No loss or gain. I lost $20. I lost $20 plus interest because I bought some time ago. I lost $75 and I gained $55. Which of the three? Peter is now going to set up a poll, and you can tell me what the answer was. Okay. And the good thing about this quiz is that there is no correct answer, but that proved my point. Okay, whole thing about market efficiency is the fact that sentiment interferes with our judgment of valuing something, like a share or an index or a futures. It actually somehow or the other human behavior comes into it, and that's because market prices can then be contorted, as Mr. Price said. We would not be able to do things properly in the market. Okay?
Khurshid, we've got about just about 60% of the audience has voted. We'll just leave. We're now showing you the results. So you can see here, half the audience, 44%, thinks there's no loss or no gain. 32% feel they've gained $55, and 20% feel they lost $75.
That's mental accounting. They're all putting it in a different compartment of their brain, of their mind. This. That's what mental accounting is all about. I can show you a motor car or a share. You will value it differently. This has always happened. This is where behavior comes into finance, which is typically about trading money. Okay, so let's see. What is, I'll come to that mental accounting in a minute. As you'll see, it plays a massive role in creating sentiment about things in a market. Sentiment could be due to your fashion, due to that we don't want to buy goods from that country, or we prefer to buy goods from this country. All these things we have to factor it all in. Okay, I don't like petrol companies because I drive an electric car. Well, okay, you may do that, but everything has a value in this world. So in the market, financial market, we believe the prices are displayed correctly. Okay? Every information there is about the goods, services, is in the price. Nothing outside. But because of mental accounting, because of our behavior, things are outside. Things you don't see. But let me celebrate my hero, Louis Bachelier. He wrote this thesis in 1900. And really a remarkable man in the sense that he actually have excelled Einstein, Kolmogorov, big people in our times, but he died in relative obscurity. Much of that later on. Bachelier's theory de la speculation, contained a detailed description of the product available at the time in the French stock market, such as forward contract options. Bachelier uses a new thing invented in physics. I'm a dropout physicist. New thing invented in physics called Brownian motion, seen by a gentleman called Robert Brown in Scotland, about things moving in a glass of water under a microscope, although there was no heat. But at the same time, we have Planck's quantum theory, and Mr. Gauss had just produced his Gaussian distribution to tell. So he applied all these ideas to stock market, and he said there is a radiation of probability in the market. Therefore, you see small fluctuations in the share prices all the time, irrespective of whatever is happening. There are small changes all the time because the markets are trying to balance them out, keep supply and demand in balance. Some people can't play with the market as well. Now, the whole thing about Shiller was his thesis was forgotten until 1960s, reinvented by colleagues of Paul Samuelson, published in English, and changed the face of econometrics and finance altogether. His work preceded that of Albert Einstein's work on Brownian motion, although Einstein didn't know about it, and he was commended by Poincaré, who was a very famous mathematician of his time. Okay, so we radiate probabilities. You don't know it. It comes to you through the medium. You know, if you read elementary physics, there are three ways of energy distribution: convection, conduction, and radiation. Action at a distance. So this information is like action at a distance, but action at a distance is actually impacted by our behavior. So, why artificial intelligence? Because what we are doing is trying to see how we can detect our level of emotion or human behavior. It's not written down explicitly. If it was, it won't be as a big a mystery as it appears to be. So we want to be a good financial trader would know how people are behaving in a market. But we want to have a machine to exhibit or simulate intelligent behavior. AI largely deals with cognitive behavior related to problem solving, language understanding, and machine vision. I could hold another poll, but I won't. What is common between the three major cognitive problems? Problem solving, language understanding, machine vision. Because we are dealing with uncertainty. When we solve a problem, an expert solves the problem quickly and differently than a novice. When we speak a language, we use a lot of ambiguity in natural language. Lot of ambiguity. But we still understand it. Now, the infant is not sent to a primary school to learn language, but by golly, within 6 years, they have picked up 5,000 rules of grammar and vocabulary expands from 20 to 50,000 words in no time. And it's all in a very uncertain environment. And when we see things, we can't see as well as a camera, but our sight can track three-dimensional motion. There are very few cameras which can detect three-dimensional motion like we do. Why? Because we are able to deal with the noise in all this. So AI deals with the noise related to our cognition, our ability to exhibit intelligent behavior. I'd like to draw your attention that language, of course, is very important. Speech is very quick, but writing is very slow. So we actually deal with emotions slightly differently also, and more effectively by looking at somebody's face when they're talking to you, or listening to the tone of their voice, or listening to their hand gestures. A very important way of communicating ideas, and is characteristic. All these characteristics are either euphoric or manic behavior. You will see that. So I'm working with groups of people. There are lots of like-minded people who actually try to simulate emotional intelligence on a machine, just to study it, just to say, I'm not going to detect criminals or whatever fashion of the day is. So I think it deals with a noise in a special category, in the category of emotions. That's what I want to detect. Time series analysis is very important, which helps to understand the evolution of behavior, say, of a market over time, but does not necessarily predict the behavior. It estimates what could possibly happen. And to my mind, time series analysis belongs to statistics, and statistics is very good in dealing with the noise of measurement. So see, my friends, I'm dealing with 3 different topics, and all of them deal with noise, hence my introduction of Fisher Black, and also I brought in my very well regarded financial economist Richard Thaler, who founded behavioral finance in more ways than one. They all deal with the noise because it's a small number of a large number of small noise rather than a small number of large noise which matters. So behavioral finance. We have simulated artificial and emotional intelligence. We want to know not only what people are saying in English, but what could possibly mean by that? What do they mean? The market has gone down, the market is moving up. I don't think the market is stock exchange as was then rises up or comes down. It's a metaphorical term to use. Our market is growing up slowly. Oh, yes, it is. But there's no speed in the market. You mean trading is going slowly. Prices change in markets are or should be due to changes in supply and demand. Rapid decreases or increases in prices outside that of random changes are seen as a sign of price volatility. It is a dictum in economics and finance that price volatility is caused by external quantifiable factors like initial public offerings. Behavioral finance experts say that it is the human sentiment which makes volatility of the price more noticeable and more exceptional. And you can see the whole idea of a market is that when you have a new thing coming along, people have a degree of disbelief, then it catches on. We hope that things will be, like, take this example of pandemic, a recovery is possible, then we show optimism, and then we start believing in it, and we are thrilled by it, then we become euphoric, and then complacency sets in, then anxiety sets in, then denial sets in, panic sets in, and then we go to disbelief. But in real markets, yes, we go from to euphoria, to disbelief, to euphoria. Okay? Now, Galbraith has told us, Kenneth Galbraith, he said that we borrow all these terms of recession, tides coming in and tides going out, like this is a regularity, doesn't quite deal with the real markets. This is what they call efficient market. It's a darling of our economics post, Mrs. Thatcher. Normally don't use her name. What happens is ideal markets are rational, benign, and predictable. Real markets are irrational, hostile, and speculative. That's what we must understand very well. So I've been working on negative sentiments and news. 8K filings, these are the returns filed by the companies in the US, a reporter, and in professional blogs, impacts on the return. That's what I look at. If there's a negative sentiment in the news, how does it impact the return in trading at all levels of economic description, like level of individual firms? We find there are 4 basis points. We don't take into account sentiment. You can lose up to 4 basis points. If you look at market indices, it's not my doing also, but other people have come to the same idea. Market indices, you can gain 4 to 8 basis points if you include sentiment into your analysis. Oil features, 7 to 10 basis points. Sovereign debt yields, less than 4 basis points. As you can see, those which are oil futures are necessarily very speculative. You're dealing with the future price of a commodity. Sovereign debt is a very stable debt, stable trading area, except you deal with people who are countries which are not very clever about the way they manage, or they're forced to do so. Market indices, slightly less fluctuating in firms. We only looked at 100 largest of American firms. We have built an information extraction system that's based on natural language processing, which is a branch of and statistical analysis, which is very important to make estimations of time series. So, our choice of words sometimes reflects how we feel emotionally. We talk about bulls and bears. We have words for evaluation of things, good and bad, up and down. We have words for denoting activation, active, passive, energetic, lazy. We have words to describe dominance, strong, weak, aggressive, submissive. Now, when you look at this, people draw these circles to illustrate what's happening. So we have high arousal and high pleasure. That means you're excited and astonished, and you're pleased when you not much high arousal, but you just pleased about things. Then we have low arousal and displeasure, tired, bored, depressed, miserable. Then we have high arousal and pleasure, sleepy, relaxed, serene, calm, confident. Now, this is quite interesting that we have found these icons to indicate our mood. They are no more than icons, right? The things manufactured as it were. They are we use them as symbols. Look, I'm happy. I'm using this word more frequently. I'm not happy. I'm using this kind of word more more readily. And there is a big debate in psychology, like everything else in psychology. It's a huge debate. But whether the emotions are categories or emotions are dimensions. So you can see we have high positive affect, active, elated, enthusiastic, excited, peppy, strong. And then we have low positive affect, drowsy, dull, sleepy, sluggish. Low negative affect, at rest, calm, placid, relaxed, stressed, fearful. And you can see that we have a choice of words. If I could detect these words, that would be great. This idea of analysis came in modern times, goes back to Harold Lasswell, who founded this whole enterprise. He wanted to put science in political science because politics was then purely qualitative analysis, just like our economists do now, sit in their offices and dream up markets. They came up with this idea of a dictionary where words are marked according to categories. And one word could belong to many categories, okay? Many categories. And they have these three dimensions: motivation, dominance, and evaluation. People always say sentiment. It's not sentiment. Positive, negative is not sentiment. It's our evaluation of things. So you have active words like abolish and passive words like accept, strong words like admire, weak words like afraid. Positive valence words are comedy, share, and sweet. I'm saying it for a particular reason. And negative affect words are conflict, crude, and debt. And if we gain something in a transaction, we say afford. If we lose, we say cut. And we have vice, which is contempt, and fall, which is correct. Now, what happens when you use these dictionaries? They were created over many, many years. A team of 16 psychologists, linguists, and all these people sat together and created the General Inquirer Dictionary, which has about 84 dimensions or sub-dimensions, and it contains about 22,000 words. Very big dictionary. It's available. It's got 2,000 negative affect words and 1,900 positive affect words. I have done lots of work in analyzing it, the references. However, when you start analyzing domain-specific text like economics, share is not a positive word in economics. It is a word which indicates something. It's not a verb, it's a noun. Debt ratio is not a negative word, we state it. Similarly, oil and gas, you don't say light, sweet, crude. It's very light, you like it, and sweet, you can taste it. No, it's just oil, crude oil. Heavy, sour crude is neither heavy nor sour in that particular sense of the word you use it. It's just a type of oil which looks like heavy and sour. In nuclear power, we have radioactive decay. Decay does not mean, it actually means radioactive rebirth, but it was called decay, invented in around Second World War. Everything was dying. And we poisoned the reactor to stop it misbehaving. Automobile anti-lock brakes are not negative, or net zero emission is not a negative thing. I think it's a positive thing. So my contribution to the literature is I have used this dictionary, and we have a program which overrides meaning categories here with our own specific dictionary. Much of my work in the last 30 years has been on how to create language specialist terms like economics, finance, oil and gas, nuclear power, automobiles, and so on.
Khurshid, I'm just conscious we're running up on the Q&A time at the moment, so just you might want to speed up a little bit if that's not too rude.
But just getting there. So we plotted out around the Arab Spring, around that time, we plotted out the grant sentiment contract value, and as you can see, it's inversely proportional to the negative sentiment. It edges on. It's correlation, it's correlation, but not causation. We will have a word about causation. So we have, if informed trade is optimistic, the nervous trade is pessimistic, then you buy arbitrage works. Informed trade is pessimistic, but nervous trade is optimistic, then you sell arbitrage works. But if both of them go in the same direction, then arbitrage fails, and you have herding, and you have bust. Thaler shows it much more better than I could do. This is all about how boom and bust happens. So you have income actual and income planned. So you have a idea, you have a startup boom and a startup burst, and then you write a book, tell-all book, to tell everybody what happened. What we found out that the sentiment sometimes determines the return of prices, but sometimes describes the returns of prices. it describes something in the past. This is what's more important. As you can see, sentiment, effective sentiment, over say from 1990 to 2005 in Dow Jones Index trading for 2017 is sporadic. With the 2 or 3 small periods, the sentiment was very effective, but we could not estimate the market correctly without including. In these areas, market return actually, the sentiment reflected the market return, and they are much more spread out. Similarly, in oil, sentiment is sporadic and generally follows what the returns do, but this is very important to determining oil prices. You can see this is the Arab Spring area. Why this happens? Because we are influenced by financial news. Financial news is written by reporters. Are they framing it? They're putting something as good, which it is, by omitting. Financial traders look at the news. Are they analyzing or just speculating about? Are they describing financial markets by understanding or just by influence? Do financial reporters describe or influence the financial markets? That's a very important point to remember. How markets move. This is the return on investment on FTSE 2000 to 2021. You can see the return on investment is generally very small, 0.05 to 0.15, 1 basis point is that, up and down. But during crisis times, here and now, during COVID, there's some activity here due to Brexit, because we hadn't decided to have Brexit, to not have Brexit. You can see it tapers off, and COVID kicks it up. So we see market sentiment can be measured by exogenous variables like number of IPOs. Depends positively that they try to do it through market variables. Baker and Woodler set it up. Sentiment index, and it's a sentiment index is dependent positively on share turnover, number of IPOs, and equity shares and new issues. It's decreased by increased closed-end fund discount and dividend premium. Standard methodology for estimating betas must take market sentiment into account. Sentiment noise, information bearing noise. So that's again the whole point of sentiment bears information, and we should take into account. Then there is whole big industry on economic uncertainty. Uncertainty, and they use terms like policy, tax, spending, regulation, and they publish these people, Baker, Bloom, and Davis publish economic uncertainty index are written every month. Actually, on a daily basis, they publish it. You can have it for free. And they look for words like policy, tax, spending, regulation, Bank of England, budget and deficit from these large number of newspapers you might be familiar with. And they come out with and also people look at message boards. Might want to put some equations in, I'll put them in now. Message board says if these are collection of words occur in these texts, then something good is happening. If these words occur in this other text, then something bad is happening. So we can use what we call Bayesian statistics to relate a stream of words to good events, a stream of words to bad events by statistics, not by having a dictionary like I showed you before. Okay? And they also note that positive shocks lead to negative returns on a message board. So this is pre-internet days, pre-social media days, but this is message boards in companies, and they looked at traffic on a message board used by a close community can be used as a measure for market sentiment. Economic policy sentiment, you can see it changes. Around Brexit time, it was very high uncertainty. This is around the time of our crash. And this is the thing coming up. Does it relate to FTSE return? Well, in some cases it does relate. We're not sure. It's a correlation, but not necessarily correlation. On the period of Brexit, uncertainty is very, very high. It sometimes reflects in the market, and sometimes doesn't. Robert Shiller's Yale Confidence Survey is published regularly, and it shows the difference between institutional investors and individuals in terms of confidence in U.S. economy in the next year, and they do it monthly. Sentiment analysis covers a range of tasks related to automatic identification of aspects of affective content in unimodal output like text or multimodal output like videos, moving images, speech, head movement, hand gestures. Tasks range from word to document level analysis, post-grain identification of subjectivity, fine-grained attribution of specific opinions, single to multiple domain input across various variety of languages. Machine learning is used, and my sort of approach, have a dictionary, look it up. Key factor in determining success of a code is the quality and volume of training data. I won't name the very large company, which is in some trouble because its language understanding data belongs to one ethnic group only, and it can't cope with other ethnic groups. If you say that, sorry, so I won't say the name. So, what are we going to do? Michael, I'm just about to finish. Text published at a specific date, time are used to extract negative words, as given in the dictionary. Number of negative words is a measure of sentiment, suitably scaled for the length of each text. We call it sentiment at time t. Market quotations are taken for a firm or index future over a period of time, and we get a series of quotes on a given date and time. Market return is computed by taking the difference of current value of the quote and its immediate previous value. Historical market returns are calculated by taking logarithm of two values. Expected average return in a well-run market is zero, as Bachelier said in 1900. Every uptick is followed by that. Return values are regressed with each other to make sure there's no correlation. There's no correlation in return values, a high correlation in price value. So these are the things which say to you, the return today depends on return the day before by this factor, and the day before that by this factor, and of course there is an error in this problem. Then we have what we call vector auto-regression. Can you see? I've added the sentiment term. Charles Simpson, Nobel Laureate in economics, also said we can add that, and we have a new text. This equation should be better than that. I won't go through this. So what we do, we do vector auto-regression and fuse sentiment and return. You might use loosely locally weighted scatter plots, known as LOIS, explore relationship between visibility and sentiment. What inference so far is, for a prolonged period, no impact of sentiment. For a short period, sentiment has impact which reverses in time, and it adds to the efficiency of ascertaining pricing. Most markets behave very similarly. You can see it's Dow Jones in 1984. This area you must take into account. You won't be able to see. When the sentiment increases, negative sentiment increases, market goes down. Proportion. It is true in Dow Jones index, it's true in a small index in Copenhagen, it's true in Shanghai index, and it's also true of the crude oil trading. This is what our finding report is that. I'm finishing my book. I don't think text will deliver very well. We talk, we are human beings. We exchange looks, we change our tone of voice. So we really should put it all together. We should get the video information of people talking during an oil price fixing game that they do it every 6 months. And use video emotion proxies and text proxies through text. And of course the quantitative data. But this is my vision of the future. I'm running a videotape. I did this exercise once, time of OPEC official news announcement. This is the price change of oil because people wonder whether they're going to raise the price or dwindle the price. This is after the thing, and I can show you the volume traded and negative sentiment changing, and return on sentiment and sentimental return. This is my dream, and I'm working towards it. Michael, thank you very much. I'm sorry to go over the time.
Well, Khurshid, yeah, it's a lot of ground to cover, and David Ball says it's very interesting, but wonders if we should perhaps be having a day-long seminar on this. Just a couple of quick questions, Khurshid. Firstly, you talk about the sort of classification of various terms. In your dictionaries, if I can call it that, how many terms are there, and what percentage of the vocabulary does it cover?
Well, it covers, there are 22,000 terms in the GI dictionary also, yeah? And then you can have that covers a significant proportion of the vocabulary, about 90 to 95%. But when we come to specialist text, we have to mine the term. So we have another system which extracts new words before it launches. And my sentiment for oil trading was very negative because they were talking about crude oil and picked up crude as negative, so it had to be fixed. That was the subject of a learned paper, by the way, later on, which is something very simple. So the coverage is good. But remember, I didn't have time to say, it is a bag of words model. I don't care about the context. If you say Negative, it won't pick it up, but people don't generally say not negative.
Okay.
So,
Yep. I found it interesting that policy, the word policy, was itself a policy uncertainty term. The minute somebody starts talking about a policy, you get really worried.
talk about policy when they're creating a policy. After it creates, it becomes law.
Yeah, well, we've been trying to get governments to calm down on policy by creating policy performance bonds. I realize I've been making a mistake by using the word policy. A couple of questions here. Hugh Purser wonders, can all of this be simplified down to something like buy on the rumor, sell on the fact?
Well, there is no doubt whatever, since I've now crossed 70 some years ago, that all these old aphorisms are correct. But it's not buy on the rumor, sell on the fact, because the facts unravel and the rumors unravel. A rumor is only a rumor somebody goes and verifies it. So it's easy to say that how will you catch rumor? How will you catch facts? I mean, we are living in an era of fake news, but generally, yes, it's correct. Michael, one thing I would say, repetition of a word is very indicative of sentiment. You will repeat Enron endlessly. I didn't have time to go through the slides. I've worked on Enron scandal and looked at the ethical terms used, wise terms, large number of them before and after. But that was very important, that Enron name kept appearing in every newspaper, every magazine. That means something was going on about it. So that's also, this is called named entity frequency, which is very important.
Okay. Jeff Ruddle is curious, is there a need to deal with positive and negative feelings expressed differently in different sectors or cultures?
Well, yes. This is a debate of emotion as a category. Paul Ekman, who's a very dominant figure in facial expression analysis, claimed to say that these facial expressions, at least, are not culture specific. They're culturally invariant. But there is an impact of cultures. We are now looking at Chinese businessmen and their facial expressions and the voice tone. They're very different, simply because our system was trained in Caucasians and Koreans. We can't deal with Chinese, Japanese, and dare I say African Americans. So very difficult. There is some cultural bias, but generally the choice of words is restricted. So I won't go into the detail. Emotion as category and emotion as dimension. The big psychological debates. I generally keep clear of.
Now, this slide here, shows just, frankly, a tremendous amount of vision and kind of volatility in the marketplace. Where you're running from facial expressions, text, numbers, etc. I think the audience are just curious about your initial thoughts on how applicable this is. So I'll start with one. Ian Harris is wondering about the interaction between some of these AI and behavioral techniques that you're describing and high velocity trading and the game based activities that go along with those techniques. He's not completely convinced that AI can detect the gaming sentiment, in giga high velocity behavior. Do you have any specific thoughts on that interaction for Ian?
I mean, high frequency trading has been addressed. But the one thing about high frequency trading is it's not a time series. A time series is a discretely organized set of points at equal intervals. If you ever look at high frequency trading, there'll be no trade for 10 minutes, and then suddenly is a burst of trading. When you look at the volume, somebody bought just one share instead of 10,000 shares. So high frequency trading is very good. People have done some work on volatility in high frequency trading using exogenous variables in the markets. They have done that and they incorporated that. They claim to see something in it. That's in academic papers. What I'll say to people is this. 100 years ago, it wasn't necessary to understand time series analysis at all in trading. You did trading on the basis. Right? It felt good. I will buy shares in company which Michael has founded because I know Michael. Michael is good. Right? Now, you don't buy shares like that. You don't know the owners. So you rely on these numbers. So my firm belief is, I'm a theoretical physicist by training, that I see the amount of numerosity in my own time increase quite dramatically. Okay? So if you're going to have electronic exchanges, personally, I think a lot of gamblers are in the market now. They're not doing any good to the economy. If high-frequency trading was good, American economy would not have any deficit. Okay, all inefficiencies would have been cleared out every second. That doesn't matter like that. The only trouble I would say, that's why I'm gone into facial expression. I get a signal every 25 milliseconds on my facial expression. Every 25 milliseconds. I might trade at 25 milliseconds, but as you know, a nanosecond is much, much smaller than a millisecond, but it's better than 1 day. Okay?
Yeah.
So as the scale increases, let me just make this point. As our video technology improves, as our storage improves, this is possible. And it's possible now for you to look at the Financial Times Index now at this minute and decide what to buy and sell at this very minute. This wasn't happening 50 years ago, unless you sat inside or you're addicted to alcohol or caffeine together. You wouldn't be able to do that. So this is just a sketch, and we are working on it. We did one study on Ryanair when there was a pilot strike in Ryanair, and we had slightly inconclusive evidence on the facial expression of Michael O'Reilly and the share of Ryanair on New York Stock Exchange.
Well, I think many people find the chairman of Ryanair a bit irrational at points, but let's not go there. Just now we spoke about high frequency trading. A quick question, almost from the other end: is this type of behavioral analysis being disrupted by the new wave of retail investors driven by social media? And that's also from you, Purser. I've got a few more questions, so if you could keep it succinct.
I will. I think yes. I mean, social media at the moment is unregulated, like motor cars were unregulated when they're built. I mean, the wheels could fall off and the brakes won't work, and the cars will, you always needed a mechanic. Some people employed a mechanic with their cars. So social media to me is the early Ford automobile, right? It's clunky, it's uncomfortable, and it can be used for more criminal purposes than it could be used for driving an ambulance for that matter. So there is a misconception that you can look into social media and find something. No, I don't think so. Find something, right? We played oil blogs by Michael. When oil traders were blogging, we could see some effect on the blogs on the oil prices in the future. Some effect, not too much, but oil blogs was important. But we could not find any statistical significant impact of the sentiment in blogs on future prices. Though there was statistically significant impact of news sentiment, especially the opinion sentiment on that, say, Lex column, and there's some other, but Wall Street Journal has an energy blog which they run. They were quite interesting.
Next one, if we could just be quick on these. Andrew Ross points out that climate change is loaded with emotion, but net zero is the number. Can this type of noise be evaluated?
Yes, it could be. Yeah, absolutely. You see, as I said to you, the traffic of a single word is indicative of a lot of things. Like use AI with everything, food, clothing with AI. That is some indicative of some change going on. Yes.
And likewise, what is your view of the current sentiment in the markets considering the economic impact of COVID? There does seem to be a bit of a disconnect from the real world. That's a comment from Paul Dooley.
Yes, Paul, let me tell you, the whole notion of political science analysis in the 1930s came because they wanted to give the correct date on which the hostilities of the Second World War will set. I'm not kidding, this is true. They took editorials from Russian newspapers, German newspapers, English newspapers, and French newspapers. And they're trying to determine the frequency towards war, the tendency towards war in those editorials. Nobody has asked them whether they were right or not, because we did have a Second World War. I am looking at COVID and the frequency of COVID and vaccines in published text. I seldom rely on it, published text. And I see there is some noise added because popular scientists like the magazine Science and to an extent Nature are translating what the experts are saying into what they call easily understandable and digestible news pieces. Now, by the time it comes to Daily Mail and The Sun, it completely goes out of control. Okay, so I don't think we can deal with COVID at the moment because there's a lot of.
All right, I'm going to try and squeeze three in, but we're past time, so we'll have to be fast. Ian Sheridan, Khurshid, the VIX index is widely monitored because it is real time and based on index option expectation of volatility. Do you anticipate many more AI-based, machine learning-based predictive volatility indices?
Yeah, all I would say about VIX is an excellent option index to use, but it is internal to the market. It looks at the prices and tells you the volatility. And to my mind, it is very important. Quantitative sentiment has very uh, small time effect. The last time you should use VIX, but VIX is no substitute for detecting correct human behavior towards prices. I don't think so. Otherwise, we will all go out of business. And for people to do something else altogether, you have to use auto heteroscedasticity models. So yes, I mean, using option trading to predict market has ups and downs. We have LCTM and merchant.
Jeremy Sosabowski, who's been on here, says he's found that order flow noise, he's in the trade really, he's found that order flow noise can contain equal, if not more, information compared to exogenous information. Has this been your experience?
Absolutely. I believe as a variable which is quantitative is always preferable to a variable which is qualitative. Order flow, and hence I mentioned message board flow. Order flow is very important. But how will you detect order flow? That's the key point. That number is verified at the end of the day. Okay? So maybe somebody placed a large order, but at the end of the day, things didn't come out. Yes, order flow is it's used extensively in gaming to substitute in teaching finance students about how the markets become volatile.
Got a lot more comments and questions. Valerie Bowens would like to know about your view of traditional banks, etc. What I would like to do is just to cover one last point. It's from David Ball, who's finding this fascinating. As a chairman of three public companies, he agrees that markets are irrational, facts are not usually well known, sentiment and herd instinct drive. He just wonders about AI. It largely works on pattern recognition, trying to imitate behavior. But if behavior is irrational, how can it ever be confident for us to believe? So better than other sentiments, perhaps, but still flawed. So there's sort of a paradox here that you're taking wild sentiment analysis and modeling it, and maybe that's a point on which to close.
I'm only modeling noise, Michael.
Good. All right, then. Well, it's been absolutely fascinating, Khurshid. Thank you so much for sharing it with us, especially during lockdown. Uh, as I said, I'll be sending all those questions and comments to you. I've got three rounds of thanks to give. The first round of thanks is very much to our sponsors. As I said at the beginning, they do let us range widely and freely across a whole variety of subject areas. I hope that today's certainly covers technology, economics, finance, and what we all think about it. Um, I would like to thank the audience. You've been particularly vibrant today, and there have been quite a few experts out there. Khurshid, we'll get your comments and hopefully respond to you. But if I could just point out, we've got a series of webinars coming up. As ever, really just go to the website. But I might pick up that Monday is going to be a pretty hard-hitting event. The time is now, the financial impact of the energy transition. We are going to have Carbon Tracker, Mark Campanale there, and they're going to be having some slides saying they wonder if ESG is of any use, really focusing on the carbon price itself. So do check all of that out. But really, the true thanks are for you, Khurshid. Thank you so much for coming on and sharing a very dense area, but one that you've got a lot of information across quickly. Unfortunately, I'm unable in these times of COVID to let the audience in for grand applause, but I have brought, as many will know, my Korean karmic clapper, and that will have to be kind of a substitute. And thank you so much, and I look forward to seeing you in the future and working with you as we have over a number of years. Thank you very much.
Thanks,